Hey everyone, welcome back to Corporate Decoder. Today, Ardian Access LLC just filed an N-2 registration statement, and I am seeing some key details about their investment strategy that could impact investors. Quick note, this is not financial advice, just my take on public filings for educational purposes. This company is basically a private equity fund structure that wants to give investors a way into private assets, but it comes with some serious liquidity limitations. So Ardian Access LLC, that is the company we're looking at, is essentially a non-diversified closed-end management investment company. Think of it as a way to invest in private equity and other private assets like secondary investments, direct co-investments, and primary investments. They aim for attractive risk-adjusted returns, which is the general goal for most investment funds. The main story here is their investment strategy. They plan to put at least 80% of their net assets into these private assets, with up to 20% for liquidity management. They are looking at secondary investments, meaning buying existing stakes in private equity and venture capital funds. They also want to do direct co investments alongside other private equity funds in operating companies and, to a lesser extent, make primary commitments to new funds. They're aiming for a global portfolio across different managers, strategies, and geographies. Now, here's where it gets tricky for investors. The units of this fund are not going to be listed on any stock exchange, and they do not expect a secondary trading market to develop. This means you can't just sell your shares like you would with regular stocks. Your main way to get your money out is through repurchase offers that the fund might make from time to time. The fund has no obligation to repurchase units, and there is no guarantee you'll be able to sell all your units whenever you want. They are suggesting this is only for long-term investors who can handle not having access to their money for an indefinite period. If you do manage to sell your units within a year of buying them, there is a 2% early repurchase fee. This is a pretty significant fee designed to discourage short-term investors. They are also offering 3 classes of units, Class J, Class I, and Class D, each with different fees and expenses. Class I units seem to be the most institutional focused, with higher minimums and no fees charged by financial intermediaries. Let's look at the fees and expenses for all unit classes. There is no upfront sales load. However, if you buy Class J or Class D units through certain financial intermediaries, they might charge you transaction fees. Financial intermediaries will not charge these fees on Class I units for annual operating expenses. The management fee is 1.50% for all classes. Other expenses are around 0.75 to 0.80%. Class J units have a distribution 12B -1 fee of 0.50%, Class D has 0.25%, and Class I has none. The acquired fund fees and expenses are about 0.57% for all classes. This means total annual expenses can range from 2.94% for Class I to 3.39% for Class J. For a hypothetical $1,000 investment with a 5% annual return, you'd pay about $34 in expenses for Class J units in the first year, $32 for Class D, and $30 for Class I. Over 10 years, that adds up to $368 for Class J, $345 for Class D, and $326 for Class I. These fees are quite high, which is typical for private equity style funds. The filing includes consolidated financial highlights for the period ending the 31st of March 2026. Net asset value per unit for Class J was $11.64, Class I was $11.66, and Class D was $11.65. The total return for the period was pretty good, around 17.33% for Class J, 17.61% for Class I. However, the ratio of net expenses to average net assets is also substantial, around 1.63% for Class J, 1.34% for Class I, and 1.53% for Class D. These are annualized figures. The risk factors section is extensive, as expected for this type of investment. A major theme is the illiquidity of the units and the investments themselves. They can't easily sell their investments in private companies or funds. This means they may have to suspend or postpone repurchase offers if they cannot dispose of their interests in portfolio investments in a timely manner. They are also exposed to valuation risk because private assets are hard to value accurately. The valuations provided by sponsors of underlying funds can be several months old by the time the fund calculates its net asset value. This valuation risk is significant. The fund's net asset value for financial reporting might differ from the net asset value used for transactions. This could mean that outstanding units are adversely affected by prior repurchases if valuations later decrease, or conversely, outstanding units benefit if valuations increase after previous repurchases. They also mention an overcommitment risk strategy. This means the fund might commit more capital than it has available. If they can't fund capital calls when due, they could face penalties including forfeiting their investment. This strategy could force them to borrow money, which adds costs and risks. The success of this fund heavily relies on the advisor Ardian US LLC. The portfolio managers listed, like Mark Benedetti and Wilfred Small, are key people. If they leave, it could materially affect the fund's ability to achieve its investment objective. Ardian Access LLC is registered under the 1940 Act as a non-diversified closed-end management investment company. This means they can invest a significant portion of their assets in a single issuer, which increases risk compared to diversified funds. The table of fees and expenses highlights the higher costs associated with these types of investments. The total annual expenses are significant, especially for Class J units. The board of directors includes interested directors like Michael Ferragamo, who is head of global compliance and risk for Ardian, and Wilfred Small, who is also a senior managing director at Ardian. This means there is a significant overlap between the fund's management and the investment advisor. Ardian US LLC has proxy voting policies and procedures to guide how they vote on behalf of their clients. Their general approach is to vote in the best interests of clients to maximize long-term value, and they generally support management's board nominees unless there are clear issues. They also consider executive compensation plans to ensure they align with shareholder interests. Looking at the ownership as of the 2nd of July 2026, Ollis & Company LLC appears to be a significant holder, with 100% record ownership of Class D units and 99.96% of Class J units. Ardian US LLC itself holds a portion of Class I units, and Ollis & Company LLC also holds a large chunk of Class I. The Limited Liability Company Agreement has clauses that essentially limit members' ability to sue the fund or its directors, officers, or the advisor, often requiring independent director approval or a majority vote of independent directors for certain actions. This is designed to protect the fund and its managers. As of the 1st of June 2026, there were 1,979 holders for Class J units, 9 for Class D, and 277 for Class I. This shows Class J is the most widely held by members. Overall, this filing paints a picture of a private equity fund aiming for high returns, but requiring investors to accept significant illiquidity and higher fees. The reliance on the advisor, the complex fee structure, and the limitations on investor recourse are all critical points to consider. It is a structure built for long-term capital appreciation, not for easy access to your money. The key takeaway is that this is a speculative investment suitable only for those who can afford to tie up their capital for an indefinite period and understand the inherent risks of private markets. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description.